Hey, in this video, I'm going to show you how to pick the best lender for Velocity Banking. Picking the wrong HELOC lender could cost you thousands of dollars in extra fees and interest. And more importantly, it might make the process of Velocity Banking even more complicated than it should be. But most people don't realize it until it's too late. The truth is, not all HELOCs are created equal. Some lenders will put limits on how you can use the line. They'll tack on hidden fees, or they make it nearly impossible to move your money around. Others, especially certain credit unions, can give you way more flexibility and better terms if you know what to ask for. Hey, I'm Adam Carroll, founder of the Shred Method. I've spent years helping homeowners pay off their mortgages faster, free up liquidity, and use tools like a HELOC to unlock wealth building opportunities. In this video, I'm going to break down exactly what makes a good HELOC lender, the red flags to avoid, and why choosing the right one is absolutely critical if you're planning to use Velocity Banking. Why lender choice matters. Before we get into what to look for in a HELOC lender, let's make sure we're on the same page about what a HELOC actually is. A HELOC, or a home equity line of credit, is basically a revolving line of credit secured by your home. Think of it like a giant credit card with a much lower interest rate. You can borrow, you can repay, and borrow again as long as you stay within that certain limit. But here's the catch. How useful that HELOC is for Velocity Banking depends almost entirely on the lender. Some make it incredibly easy to move money in and out, to track your balance on your phone, or even use a debit card linked directly to the line. Others might bury you in fees. They restrict how often you can transfer money, or they make the application process extremely painful. The non-negotiables for picking a HELOC lender. Now, when it comes to picking the right HELOC lender, most people make the mistake of focusing only on the interest rate. They see a number that looks lower and they assume that that's the best option. But if you only focus on the rate, you can end up with a HELOC that looks great on paper, but is almost impossible to use for Velocity Banking. At the Shred Method, we've looked at dozens and dozens of HELOC products across banks, credit unions, and online lenders. And what we found is that the best ones all share a handful of features, things that we consider non-negotiables. So if your lender can't check these boxes, then it's probably not the right fit. Number one is the rate structure. HELOCs are usually tied to the prime rate plus a certain margin, and those margins can vary widely. Even a 0.5% difference can add up to thousands of dollars over the life of the line. So ideally, what you want is a fixed introductory rate for at least 6 months to a year. Why? Because in those early months, you're learning the system and you're building momentum. If your rate shoots up right away, the strategy starts to feel painful before it even gets started. Number two, unlimited withdrawals and transfers with no fees. Velocity Banking works because you're cycling your income through the HELOC. If the lender caps your transfers or charges a fee every time you move money, the system starts to break down a bit. Imagine having to pay $10 just to move your paycheck in or out. You'd be throwing money away every single week. But with the right lender, you can transfer as often as you like for free, whether it's $10 or $10,000. Number three, low transparent fees and an easy application. A lot of people don't realize how quickly hidden fees will eat into their interest savings gains. An annual maintenance fee of $150 or a $50 underwriting fee here and there, it may not sound like much, but when the whole point of Velocity Banking is to save interest, those charges slowly undo some of your progress. And if applying takes weeks of paperwork and in-person meetings, you might lose patience before you even start. Listen, the best lenders keep fees minimal and the application process simple. Often it can be done entirely online. Number four is ease of access. To make Velocity Banking work, you need to know your numbers at all times. If you can't log in on your phone, see your balance instantly, or move money in seconds, then we might call that flying blind. Some lenders even issue a debit card that's tied directly to your HELOC so you can treat it like a checking account, similar to your debit card. That's the kind of convenience that keeps the system flowing very smoothly. The easier it is to access and pay back the funds, the easier it is to leverage the Shred Method and Velocity Banking. Number five, support and flexibility. Mike Tyson famously said that everyone has a plan until you get punched in the face. You may need to refinance down the road, or just call someone to help fix an issue. A lender with super rigid policies and no human support can begin to make you feel like you're trapped in the product. But a lender with local underwriting and a real phone center can adjust with you. And that flexibility makes all the difference when you're trying to run a strategy that lives and dies on the ability to run cash flow through the system. These are not nice to haves, they're non-negotiables. So if a lender can't check every single one, it's probably not the right fit. Why credit unions often win. And if you're thinking, boy, these are a lot of boxes to check. Well, you're right. And that's because choosing the right lender could be the difference between paying your mortgage in 3 to 7 years or grinding it out for 30 years or more while staying in debt the entire time. So who actually checks all those boxes? Well, your first thought might be to go to a big name bank that you trust, one that's in the news, one that has giant branches on every corner. But in our experience, it's rarely the big national banks. You see, big banks tend to operate with a very rigid, one-size-fits-all underwriting policy. Their underwriting tends to be centralized. Their products are designed for the masses. And if your situation doesn't fit their box, you're out of luck. So they may have a recognizable brand, but that doesn't help you when you're trying to run a velocity banking strategy that relies on flexibility. Credit unions, on the other hand, are usually a very different story. Because they underwrite loans locally, they can look at your whole situation instead of just the numbers on your application. That local decision-making means more flexibility on terms, easier approvals, and quite often better rates. It's kind of like the difference between grabbing a burger at McDonald's versus your neighborhood diner. At McDonald's, you get the same thing as everyone else. At the diner, they know your name, they tweak the order for you, and they care if you come back. That's how credit unions approach lending. On top of that, credit unions are member-owned, which means they're designed to serve you, the member, not a bunch of shareholders. So what that often translates to are lower fees, better customer service, and products that align more closely with the non-negotiables that I just talked about, like unlimited transfers, lower no fees, and easy online access. So if you're serious about velocity banking, don't just default to the big national brands. Take the time to shop around with local credit unions. You'll often find that they are the hidden gem when it comes to HELOCs that actually work for this strategy. Your action plan for picking the right lender. All right, so now you know what to look for and why credit unions often come out ahead, but how do you actually put this into action? Step one is you shop around. Don't just talk to one lender and call it good. Reach out to at least 3, a credit union, a regional bank, and even check where you have your current accounts, because you'll quickly see how different their products are. Step 2 is use the non-negotiables as your checklist. Literally write them down. Fixed intro rate, unlimited transfers, low fees, mobile access, and solid support. Ask each lender how they stack up on every point. And if they can't give you straight answers, that's probably a red flag. Step 3, compare the total cost, not just the rate. One lender might offer a teaser rate that looks fantastic, but then they bury you in annual fees or transaction charges. Another might have a slightly higher rate, but no fees at all. And when you add it up over time, the second option is usually better for velocity banking. Step 4, make sure the application process doesn't turn into a nightmare. The best lenders make it smooth and online. If you're being asked for endless paperwork, or if it feels like pulling teeth just to get approved, that's usually a preview of how they'll treat you once you're a customer. Now, keep in mind, you will need to provide an application, they'll probably verify your income, and you might need to have an appraisal done on your property. All of this is pretty customary. If you follow those steps, you'll land on a lender that doesn't just hand you a HELOC, but actually gives you a tool that you can use to accelerate your payoff and to truly unlock wealth. Oh, and one more thing. A question that we often get at the Shred Method is, how much of a HELOC should I ask for? And this is a great question because there are a couple of caveats to consider. First of all, getting as much as you can is the simplest answer. If you have access to $100K or more in equity, you're super well positioned to use that equity for investing. So I would go in and say, I'd like to request a $100,000 line of credit. However, if your income doesn't support the monthly payment on a $100,000 limit, then going in and asking for 10 to 20 grand is plenty. The challenge is that the banks might underwrite your ability to make the payment based on the full amount being borrowed. So if you go in and ask for 100,000, they're going to assume that you're going to take the full 100,000 out, and they want to make sure you can afford the payment on that 100,000. The reality is that velocity banking doesn't require a huge amount of availability on the HELOC. That $10,000 to $20,000 mark is plenty. Remember, we're using it strategically, and the software tells you exactly how much you're going to send out on a daily, weekly, and monthly basis. So here's the bottom line. The lender you choose can make or break your velocity banking strategy. Pick the wrong one and you're stuck with fees and limits and headaches that undo some of your progress. Pick the right one and your HELOC becomes a powerful tool to accelerate your debt payoff and to truly unlock wealth. The good news is you don't need to guess. Stick to the non-negotiables I shared here, shop a few lenders, and don't be afraid to lean toward credit unions that underwrite locally and put their members first. And if you want to go deeper and you want to see exactly how to put all of this into motion, not just picking the right HELOC, but using it to pay off debt faster and build wealth, click on the link below in the description. That's where I walk you step by step through the process and show you how to make this strategy work for you in real life. Smash that like and subscribe button so you never miss another video. Thanks for watching, and I'll see you in the next one.